Welcome to this weekly installment of the Whitaker-Myers Wealth Managers What We Learned in the Markets This Week. My name is Summit Puri and thank you for tuning in. This week, as usual, we'll discuss 4 key focus points highlighting the key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll take a look at the jobs report, specifically looking at non-farm payrolls for November. In point number 3, we'll take a look at the ISM Services PMI. And in point number 4, we'll take a look at the Federal Reserve Jerome Powell's comments from the last week. Now, on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta Fed GDP Now report shows a healthy 3.3% growth as of December 5th, which is up from the previous estimate of 2.6%. This data incorporates the BEA's recent data release as well as the ISM Services data, which we'll discuss later in this video. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of the labor market. This week, initial claims data showed an uptick of 11,000 claims, ending at 224,000, as continuing claims fell to 1.871 million. Next, for 2024, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw a dip in the 30-year and 15-year mortgage rates, ending at 6.69% and 5.96%, respectively. Next, we'll take a look at investor sentiment. One component of investor sentiment is the measurement of the bull-to-bear spread. The latest update shows the bull-to-bear spread rose from negative 1.59% last week to 17.67% this week. Investors are feeling increasingly bullish going into this week. Next, we will continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 86% probability of a 0.25% decrease and a 14% probability of no decrease in December. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 0.73%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was negative 1.01%. The MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the US, was positive 1.52%. International stocks got the much-needed win again. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. On to point number 2, jobs data, non-farm payrolls. The U.S. Bureau of Labor Statistics reported that total non-farm payroll employment increased by 227,000 in November, and the unemployment rate remained relatively stable at 4.2%. This signifies a positive trend in the labor market, with employment growth observed in several sectors, notably healthcare, leisure and hospitality, government, and social assistance. However, the retail trade sector faced job losses during the same period. The report also highlighted specific industries that contributed to the employment growth. Healthcare added 54,000 jobs, consistent with its average monthly gain over the previous year. Within this sector, ambulatory health services or healthcare services, hospitals, and nursing and residential care facilities all experienced job increases. Leisure and hospitality also saw positive growth with 53,000 new jobs, primarily in food services and drinking places. Government employment continued its upward trend, adding 33,000 jobs, particularly in state government. The transportation equipment manufacturing sector experienced a significant increase of 32,000 jobs, largely attributed to the return of workers from a strike. Despite the overall positive employment growth, some areas of concern emerged. The retail sector lost 28,000 jobs, particularly in general merchandise retailers. This decline contrasts with the sector's relatively stable employment figures over the preceding year. The report also noted that the number of long-term unemployed individuals remained elevated, greater than 1.8 million, which we discussed previously. This indicated persistent challenges of certain segments of the labor force. Additionally, the labor force participation rate remained within a narrow range, suggesting limited growth in the overall pool of available workers. On to point number 3, the ISM Services Index. The Institute for Supply Management, or ISM, reported that the services sector in the United States continued its growth streak for the 5th consecutive month in November. The services PMI registered at 52.1, indicating expansion, although at a slower pace compared to October's 56. This slowdown follows a trend of decelerating growth observed in recent months. Notably, 14 out of 17 sectors tracked by the ISM reported growth, with accommodation and food and services, arts, entertainment and recreation, and healthcare and social assistance among the leading sectors. Despite the overall expansion, certain sub-indices revealed areas of potential concern. New orders and businesses activity production both declined for the 5th consecutive month, suggesting a potential softening in demand. Employment also experienced a slowdown, growing at a slower rate for the 2nd consecutive month. This deceleration in hiring may reflect a cautious approach by businesses among economic uncertainties. Adding to the mixed picture, inventories contracted significantly, declining by 11.3% after 3 months of growth. This sharp drop is attributed to businesses adjusting their stock levels in anticipation of potential disruptions caused by a possible port strike and seasonality factors. Additionally, supplier deliveries moved faster in November, indicating an improved supply chain conditions. Prices, however, continued their upward trend, increasing for the 90th consecutive month, although at a slower pace. The report also highlights the impact of external factors, such as the election results and potential tariff changes, on business sentiment and decision-making within the services sector. On to point number 4, Federal Reserve Chair Jerome Powell's speech. The Federal Reserve is likely to proceed cautiously with interest rate cuts, as indicated by Chair Jerome Powell's recent comments on December 4th. Powell highlighted that the U.S. economy is performing better than initially anticipated in September, when the Fed began reducing interest rates. Factors contributing to this positive outlook include a stronger labor market and slightly higher inflation compared to previous projections. Despite the positive economic indicators, the Fed remains attentive to potential challenges. Concerns persist about inflation remaining above the 2% target and the potential impact of external factors like trade policies. Additionally, some key economic indicators, such as new orders and business activities, have shown slowdown in the services sector, which we highlighted in point number 3. This cautious approach is reflected in market expectations of a potential quarter-point interest rate cut in the December meeting, although some of Fed officials, like Christopher Waller, emphasize the need for data-driven decision-making and the possibility of maintaining current rates depending on incoming information. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest video on your feed, including new content released by our team, please make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you again for watching. We look forward to seeing you next week.